Good morning, everyone. Welcome to the Roots Results webinar series hosted by Manitoba Crop Alliance. My name is Ashley Amater. I'm a whole farm specialist here at MCA, and I'm going to be facilitating today's session. This is one of 5 webinars in our series exploring farm business management topics that can drive measurable outcomes for your farm. So we're so pleased to have you all join us today. Before we begin, we have a few quick housekeeping notes. First, today's session is looking to last about 60 minutes, and we're going to be including time for Q&A at the end. So please feel free to submit your questions anytime using the Q&A feature at the bottom of your screen. We'll gather those up and address as many as we can at the end of the presentation. Also, please note that the session is being recorded and will be available on our YouTube channel following this webinar. We'll be also producing wrap-up articles that will be featured in our monthly e-newsletter summarizing key takeaways. So with that, it's my pleasure to introduce today's speaker, Evan Schout. Evan is the president and co-founder of Maverick Ag, an agriculture and insurance consulting firm in Western Canada. He's also the CFO at Hebert Grain Ventures, a grain and oilseed operation in southern Saskatchewan, and the lead coach and co-founder of Farmer Coach, a program for primary producers in both Canada and the US. You can also catch him as the host of the Truth About Ag podcast, available on the Real Ag Media Network. So we're very excited to have Evan with us today to share insights on monitoring finances to manage farm risk. And so with that, I'll hand things over to you, Evan.
I appreciate the intro. I know you pulled it right off the website because I've probably heard it a lot this winter. So
Yeah.
yeah, before I start the presentation, guys, I just want to say this is not my forte, and what I mean by that is I like to call myself a recovering accountant these days. They've asked me to go through some of the financial side of agriculture, and that's, I guess, where our firm spends a lot of its time. I get to play more on the entrepreneurial side. So I'm gonna try not to be preachy today and lead you down too many numbers. So we're just gonna hit some of the high-end numbers and high-end theory towards the financial management side of agriculture and the dollars and cents. So here we go. Should be good there, Ashley.
Looks great.
Okay. So interesting little story I'm going to start with, guys, is we do a lot of work with Real Ag through the Truth About Ag podcast. And I was interviewing Sean one time, and he made the exclamation that he doesn't talk about financial acumen with farms a lot during his presentations for the simple realization that it creates a lot of emotion and a lot of discussion along farms of they understand their business and they like to stick to their guns on that. And I'm not here to say you don't. I'm here to try and give you as many tools in your tool belt, stuff that might be outside of the realm that you're currently doing, or stuff you might already be doing and just a little bit down the line. So the biggest thing that I've seen in agriculture is the problem that we've had is that when I grew up, there wasn't money in agriculture. I literally have my CPA because my dad told me to leave the farm because it wasn't profitable at that time. Now, joke's on him. I came back, bought the farm out from him, but it turned into that running joke of, as agriculture producers, we were allowed not to have to go down the finance route because we had land. And over the last 20 years, real estate has outperformed farms 10 to 1. But in that same breath, it's allowed the farms to also expand and grow and be financial stable. So from that standpoint, the interesting part is that now the producers need to start catching up on that financial acumen side. And that's where we do most of our business, to be fair, whether it's Maverick or Farmer Coach, we spend a lot of time on the finance side. And we've done enough surveys through Hebert Group and through the rest of our organizations that we know that that's where farms are asking for the assistance. So that was part of why I'm here today to talk about some of that. So with that in mind, we are going to move in to the slides. So interesting way to start, and I used to tell this as a joke when I started speaking, was the true definition of farming is the art of losing money while working 400 hours to feed people who think you're trying to kill them. And it used to be a running joke, but to be fair, it's almost become commonplace now. Is going into 2026, if anybody hasn't run their numbers yet, it looks tight. And whether you're in North America, whether in the US, Canada, it's the same mentality of how do we make money? And when I look at farms now, and this is going to make me sound super accountanty, but when I look at it, My definition is more, how do we use the financial management to turn perceived uncontrollable risks into strategic controllable processes? And it sounds like a mouthful, but technically all I'm trying to get at is we look at agriculture and we look at weather and we look at markets and we look at a whole bunch of these items and we call them uncontrollable. We don't control Mother Nature. We don't control how much rain we get. We don't control what the markets do. In fact, markets right now, this might be the least control we've ever had from the geopolitical side and the policy side. Then we look at interest rates and inflation and foreign exchange. All of these things have detrimental effects or positive effects on the farm. But from our standpoint and our business side, we call them uncontrollable. And that's where the starting point of this presentation is that I don't believe in uncontrollable risks. I believe that there are things out of our control and how we handle them is totally within our control. So, in that same effort, on the controllable side, as a business owner, and that's not farming, that is straight industry, doesn't matter what industry you're in. As the CEO of your company, you're in charge of doing what you can to minimize the risk from the uncontrollable. And the way we do that is data, it's numbers, it's operations. So today, where I'm going to concentrate most of my energy on is key performance measures. So identifying those ratios within your finances that are actually going to help you control the risks that are coming at you every single day. Most of the decisions you guys make within your careers, they're going to be $1 million decisions. I remember looking at my house mortgage when I bought my house and realizing it was actually my fifth or sixth biggest loan on the farm. So you guys have an immense amount of capital, debt, leverage, and tight margins to deal with. The first step is figuring out what those key performance measures of your operation are and how they affect your operation. Secondly, cost of production. We're going to go into depth in this one because I believe it's one of the most misunderstood terms. It's utilized considerably across the industry. Everybody realizes they have to know what their costs are. But at the same time, the actual number that they come out with is so differential between different accounting firms, different farms. So we need to have a set of standards of how to actually calculate cost of production. So we're going to go through that today. Return on investment. This one, again, is probably one of the most misunderstood of the fact of how do we start looking at expenses on our operation more as a return. So the big one for me is always labor. We always look at labor as an expense. Well, with a lot of the operations that we started working with now, they're looking at it as a return on investment. How do I bring someone in to do a job that is not creating a big enough return for the farm so that I can go do something else? And by that something else, I don't mean taking trips down to Arizona or to Hawaii. I literally mean sitting down at a desk and going over the marketing plan or the capital plan or the strategy or finance or dealing with the banks or accountants. Those are the tasks of a CEO. And those are also the tasks that I believe get pushed to the back because production always becomes number one. So we're going to talk about that as well. We're going to lean into risk management. And when I say risk management, most people think I'm only talking insurance. There is multiple ways to risk manage a farm. And you'll see the two below. Those are two of the methods. One is lean management, which is what areas can you actually cut? I mean, we're going into 2026. We know things are going to be a little bit tighter. Where should we be looking for those extra little 5% advantages that are going to keep us above break even? And then the last one is benchmarking. And this is one of the most advantageous and disadvantageous identifications in agriculture. And what I mean by that is on the advantage side, you get to see numbers of other farms, of other geographies, and to be fair, of other competitors. Because in agriculture, we always look at our neighbors as if they're our neighbors and, lifestyle, agriculture, they're your competitors. And the sooner we realize that, the sooner we can start looking at them as such, and the sooner we can start seeing what they're doing that's different than us and taking the ones that are good. So that's where benchmarking comes in on the positive. On the negative is if you rely on benchmarking too much, you don't know the story behind some of it. I tell the story a lot during our presentations of on the benchmarking side, our LPM, our labor power machinery costs, specifically machinery, used to be quite high. And then we identified that the amount of dirt work and custom work and all those things that we were running through those expenses, and then we weren't identifying the revenue on the other side. So if we found 10 more acres on a piece of land, we created 10 more acres of actual real estate, but that's never picked up on the income statement. So our LPM number might have seemed high, but then in comparison to farms that don't do any dirt work or don't haul their own grain or that side, it became a bit of a crutch. So that's where we're going to take this today. So we're going to start with the key performance indicators. And I don't want to, again, be too preachy on these, but these three, if you're going to write something down today, these next three, this is what you write down. These are essentially the bank ratios that are going to keep you in business. And I believe there's some very, very important ones and there's some that are less important. But right now and today, these are the three that matter. Number one is working capital. And when I say working capital, I'm talking about liquidity. And the big thing we always talk about on liquidity is that the majority of farms today, if they bought land 10 years plus ago, they're not going to go bankrupt. We have a significant amount of unused equity in farms today. And that's a great positive. It means there's low security leverage. It means you guys have that wealth for retirement or for succession. But on the other side, what it means is we have to look at other areas that are going to be significant. And that's when we start talking about insolvency. There's a higher risk of a farm becoming insolvent, which means no cash, than there is bankrupt. So working capital tends to be one of the significant ones because it does affect your day-to-day operations. It affects how much cash you have, when you have to sell grain, when you can buy your inputs. Its largest effect is probably on margin, to be fair. And what I mean by that is the farms that can do considerably stronger margins are because they're buying at the right time, they're holding grain when they don't have to sell. That's where working capital comes in as a strength. On the second side, debt service. This is the one that's not as well known as working capital. Most people know how much cash is in their bank. The debt service ratio to me is actually the most important, especially with the farms that we work with within Maverick. And the reason is debt service identifies to me whether the bank is going to be on your side next year. And what I mean by that is it takes your cash earnings, which is how much cash you produce from the farm over a certain period of time. Some it's 3 years, some it's 5 years. And then they identify what your debt payments are in comparison. And the reason they do that is it tells the bank whether over an average period of time, if you have average growth and average crops and average prices, can you actually make repayment on the debts that they've given you? And this one is where I think we're going to get caught with a lot of farms is that as we have downturns in the industry, a repeated downturn over multiple years has the most detrimental effect on debt service. Because we have insurance programs, because we have that side of it, working capital usually isn't pulled into too much unless you have a catastrophic loss. However, as you strip down your debt service ratio, that's the one that's going to tell them to stop lending to you. And that's the one where it slows down expansion. And then you create tax issues, or it doesn't allow you to upgrade equipment. So then you have efficiency issues. That's the one that comes into effect really tight. And then the last one's debt to equity. And this one's the leverage one. And the reason this one's the last one on my list is that, as I said, over the last 10, 15, 20 years, we've seen a lot of equity growth. Now, if you're a young farmer who's just starting out, this one might be your most significant. It's just if we look on average across farms and succession and transition, this one seems to be the least crucial. Now, when you look at this one puts together in mind how much equity you have in your assets. So whether that's equipment, infrastructure, land, and it literally compares it to how much debt you have for that corresponding asset. Most banks, for example, if you went to buy a quarter of land, they require 20% down. So right there, if you just put the minimal amount of 20% down, you would have an 80% loan to value. So that means your debt to equity, you have 80% of the debt for 100% of that asset value. If it stays at 80, you're great because that 20% is kind of the buffer for the bank. Now, in today's environment, you hear a lot of people talking about land going up, going down. If it goes down, all of a sudden you're leveraged more because instead of 80%, you're now 85%. That's where the risk of a land depreciation comes in, is if you get above that parameter of that 20% buffer that the bank likes to have. Now, for most of the farms we work with, they're considerably way more equity than leverage, which means they're probably in that 50 to 40% rate, which means if a 20% drop in land happened, there's zero effect. And that's the scare tactics we hear with a lot of, land sales, real estate, all that stuff. What if this happens? Well, if you're in a position where your debt to equity on your land is only at a 50%, nothing happens. The banks don't call any loans. You're not underwater. That's where the scare tactics and fear come into the industry, is just a misunderstanding of what that ratio means. Now, just to go quick, I don't want to get lost in the numbers, guys. Just for quick explanation sakes, when we talk about working capital, it's current assets minus current liabilities. If we talk about the ratio, it's current assets divided by current liabilities. Now, in explaining that, a current asset is anything that could be turned into cash in the next 365 days. So 1 year. So that includes cash, AR, inventory, prepaids, your agri-invest account, your trading account. All of those things can be turned into liquidity very quickly. Now, on the current liability side, same thing. What do you have to pay in the next 365 days? So that includes your operating line, any accounts payable, grain advances, any retail financing. And the big one is your current portion of your long-term debt. So what principal payments do you have in the next 365 days? That's your current liabilities. You take one, divide it by the other, and you get a current ratio. And as you can see in this picture, if your current ratio is anything above 1.5, you're in a green area. It means you're a safe farm, you've got lots of cash, it's not affecting your decision making. You are in a very strong position. You'll also see that anything over two, I've got redded out. Now, I get a lot of pushback on this from the accountants and a few others, but to me, that means you're sitting on a boatload of cash that's earning no return. So you're in a safe spot, probably over safe. What to do with that cash? And to me, it doesn't have to get invested into land. It doesn't have to go somewhere where you can't turn it back into cash, but you should be earning a return somewhere on that cash rather than just sitting on it and feeling good about it. Now, if you get into the 1 to 1.5 ratio, you're probably starting to see some of your decisions get pushed by cash. So if you had the bins closed, but you got lines of credit that are due in February and you have to sell grain, that means you're probably in the yellow spot because you had to sell grain. If you're in the red and you're below one, that technically means you're paying next year's, last year's expenses with next year's revenue. And that's a position you don't want to be in. The other two ratios, you can compare your working capital to your total cost of production, which I don't want to get into because we are going to cover a little more on cost of production in the future. You can go back through the webinar once it's up on the website and have a look at some of these if you like. When we look at coverage ratios, so this is your debt service. The first thing to understand about debt service is EBITDA. This is just how you calculate how much cash you earn based on your income statement. So when the accountant gives you your income statement, you essentially take it, you take your net earnings, and you add back any extraordinary items that really aren't going to happen year over year. You add back your interest because that's in a different part of the equation. You add back your income taxes, and you add back your amortization. And the reason you add back amortization is even though amortization is a cost, and you can disagree with me if you like, but when you go to trade a piece of machinery after 1 or 2 years of owning it, it's declined in value. That's what amortization is. It's that upgrade cost to go from the 2 years you owned it to something 2 years newer. And the reason it's not considered a cash earning is because if you don't trade, it doesn't happen. So the year you trade, you're going to realize what the amortization was. It's just for accounting purposes, they calculate it year over year. For you, you're only going to incur that cost when you trade the implement. So they add it back and it gives you what we call EBITDA, which is earnings before interest, taxes, depreciation, and amortization. The big one is it's your cash earnings in layman's terms. Now, what they do for debt service calculation, they take that cash earnings and they compare it to how much principal and interest you're going to pay over the next year. So your total debt service. And what that does, it identifies, do you make enough cash earnings in a year to cover your payments? Now, the part that some people leave out that even I don't have in this slide is they include your personal drawings in your debt service calculation as a loan payment. So if you are not putting that into your cost of production and you're not taking account how much you draw out of your company or out of your business every year, the bank is. So when we get to the cost of production side, you're going to see that we include it. For this reason is that all the advisors that determine whether you get financing or not, they include it. So it's considered a loan payment in this equation. Now, the majority of banks that we're seeing today, especially the nationals, we're seeing somewhere in the 1.1 to 1.25. That's the covenant that they require you to hit, which means you make anywhere from 10% to 25% additional cash over your debt and personal drawings. Now, if you're under one, that means that you didn't make enough cash to even pay your debt and take any money out of your company or your business. 1 to 1.5, as I said, if you're below your covenants of the bank, you're probably still in the red. But that 1 to 1.5 gives us breathing room because you did hit your covenant. Anything above 1.5 technically means safe. Don't get me wrong, we've got farms that are 2 to 1, 4 to 1, 5 to 1. And all that means is they probably haven't expanded a lot in the last few years, which has left their leverage quite low unless they've invested in a lot of equipment. From that standpoint, you're in a very safe zone, which means you're probably ready for that next expansion or you have room. And remember, this is over a 3 to 5 year term, which technically means one bad year is not going to wreck this ratio. The banks look at it, some look at it from a 3 year average, some from a 5 year, and that's how they calculate the ratio. The last one, debt to equity. Now, the only thing to remember with this one is that it's not really debt to equity, it's debt to what they call tangible net worth. And the reason I say that is if you look at your balance sheet from your accountant, and I'm hoping everybody on the call has accrued financial statements. If they don't, that's where I should have started this whole webinar was you need to get accruals. Now, if you look at the balance sheet from the accountant, everything on there is at cost. So if you paid 30 grand a quarter 20 years ago for your land, that's the value it has on the balance sheet. The reason I use the term tangible net worth is when a bank looks at your debt to equity, or when you look at your debt to equity, you need to have fair values for that land. You also need fair values on the equipment, but for most enterprises that have at least upgraded within the last 5 years, there's not a huge gap there between cost and fair value. But if you run older equipment that's you have fully depreciated, but it's still worth something, you probably have to add some fair value for the equipment as well. And all that does is it compares what's your debt to what's your total fair market value of all the assets you own, your debt to your equity. Now, in comparison, anything from that 0.5 to 1, probably green. I've had banks that'll go up to 2, and I've had banks that have actually curbed the ratio even up to 3. You do not want to be there. We always used to joke that the banks will give you enough rope. It's our job to make sure you don't hang yourself with it. And that's how banking works. Their job is to allow you to keep running your operation how you see fit. When you work with our group, my job is to make sure that you run your business to where the risk doesn't get too high. And that's the correlation between the two. Okay, moving on to the next one, cost of production. And this one, guys, is probably one of my favorites because it's probably one of the ones that I get to have what's the conversations around mostly, debates. So when we talk about cost of production, we're going to look at a few things. But before I go down this list, I do want to discuss one or two things. As I've mentioned in the past here, amortization, it's a cost. It needs to be included in your cost of production. If you never plan on trading any piece of equipment you own on the farm, great. We can have that debate, but that's not the reality. The reality is that one day you're going to have to upgrade a piece of equipment and you're going to have to pay the upgrade value, which is the difference between the new one and the old one. That was the amortization that you lost on that equipment. So it needs to get put into your cost of production. Now, if you don't know how to calculate amortization, go to your tax return, the CCA rates that your accountant has put on your tax return. The good rule of thumb, take 50% of that. That's what the majority of the accounting firms use for amortization. Whether you agree or disagree with that number, that's the industry average. I do have some farms that would go through and essentially know and get quotes from dealerships and see what they lost over the year. Accounting won't use those numbers, but if you want to use them internally, it's a great way to know exactly how much loss of value on your equipment that you had. Second, we talked about personal drawings. They need to be included. Now, the one caveat I have is that a lot of time personal drawings on a farm, they're based on tax planning by the accountant. So what dividends should we give you for the best tax rate? The number I want you to use for your cost of production, I want you to use what your actual drawings and expenses are throughout the year. What do you need to live off of? Your meals, your travel, your personal vehicles, your house mortgage. The amounts that you're actually drawing out of the company, that's the true cost of production number that has to go in. Lastly, and this is the one where I can get debated the most, and I'm okay if you don't put this in, but I do want you to run the number just for your own knowledge. Personal land rent. And what I mean by that is when you calculate your cost of production, any land rent you pay to a third party, that's included in there. It's a cost of doing business. But what we've done is that we've also said that your own land that you've paid off, or maybe you are paying off, you never actually allocate a value towards that. And the one consideration is if you didn't farm, could you still own land and make money on that land? And the answer is yes. I've got lots of guys who invest in farmland and they rent it out to farms and they make a return. So I think you need to at least have the conversation with yourself of if I were to pay that, how much is left in the farm, aka farm profit, and how much do I make on my real estate? So if your real estate is fully paid off and you're in an area that's $100 an acre, you're probably making a pretty good return on your real estate, but then you come to realize that there might not be a lot of profit left in the farm. And if we look over the last decade to 2 decades, I think what we've seen is the majority of wealth in agriculture has been made in real estate. And I'm not offside saying that. The returns on real estate have been considerably higher than the returns on farms. So by doing this, if you don't want to include in your cost of production, that's totally up to you. But at least run the number to see, am I still viable as a farm? Because if I had to pay myself or pay a third party for that same land rent, the lost opportunity cost, could I actually make money farming still? So the farms that we work with, we try to have them at least run that number, if not allocate a number on their budgets for that, because it is an actual real estate cost and you are running two businesses. You're a real estate holder and you're a farm. And if you don't divvy those across, the waters get very murky. Now, when we walk into this, the break even analysis, guys, this is a way of essentially sitting down and on a per unit identifying with all the costs included on that piece of land, what do I need to make per bushel or per head or per kilogram just to pay my bills? And that includes amortization, management draws, everything we talked about. The reason this is important is this will then allow you to sit down and say, what do I need to sell my grain or my cattle for just to break even? And from there, we can start talking the next one, which is marketing and return on investment. So per unit of cost analysis and return on investment, essentially, what number am I comfortable with selling? So if we look at last year, for example, we didn't sell a lot of wheat to start the year because the price wasn't where I wanted. Now, hindsight, we should have sold the wheat, taken the loss, because at that time the loss was less significant than it is today. But that's a very hard pill to swallow for a lot of guys, is selling into a loss scenario. But because we had other grains that were still in a profitable position, we would have mitigated the downside risk and still came out better ahead as a whole farm operation. It's those discussions that I believe aren't happening enough in farming and in agriculture. And I'm not saying that I know marketing because I don't. And that's why there is no marketing section in this presentation, because that is not my specialty. Honestly, we have a marketer in the farm that does it for us. But from my standpoint, I provide him all of the tools so that he can make the plan, which is a per unit review, a cost analysis, and a return on investment strategy that works for the farm as a whole. Last one is opportunity cost. What I mean by this is the cost of carry and the loss of not having the cash in the bank for future opportunities. And the reason that's important is right now we look at prices, we say we're going to lock the bins, and that's fine. We're sitting on grain. Lots of farms I run with are sitting on grain, hoping for a bullish market. Now, the word I don't like using is hoping. The discussion that we've had with a lot of our farms is that there is a cost to carry. If you're sitting in your operating line, the cost to carry on grain is probably the interest rate on your operating line. So prime plus one, prime plus two, whatever your operating line is sitting at. If you are in a cash position, the cost of carry is probably what you could earn if you put it into a GIC or a risk-free investment, because that is what you could have earned had you had the cash in hand and done something with it. And then the lost opportunity is, are we turning down any expansion opportunities or places to put that cash that would create a return or additional employees or whatever it might be because we're holding it? What is that lost opportunity cost? And that's the one that's probably the hardest to calculate. So when we talk about break-even analysis, guys, I've given just a small example here. And this is a client example, 22,000 acre farm. I chose a bigger one just so you could see the multiple crops and the multiple acres and the multiple exposure that they have. So when we look at this, you go through, and the big thing with break even is you need to figure out the yield. And yield, guys, please do not take the yield you're shooting for. Take your 10-year averages. Everybody that has crop insurance has a crop insurance what if, shows their 10-year average, their guarantee. Use that number. I don't care if you're fertilizing for X amount of bushels that you've never grown before, but you're fertilizing for it this year. Do not use that number. Conservatism is your friend when it comes to break-even analysis. Secondly, price. If you got contracts, put that into the analysis. Other than that, the uncontracted price is the price today. It's not the price that your marketer says he hopes we can get in 6 months. Put the one as of today so we know using today's prices, this is where we sit. Fertilizer, chemical, seed, insurance, same thing. If you've already bought your fertilizer, this is an easy calculation. If you plan on buying it, what's the cost today? When you get down and we get into the labor, power, machinery, and land building finance discussions, I want you to look this up online. There's going to be resources online that'll show you this. Depending what accounting firm you're with, it'll be called something else. The reason we use these is because it allows me to benchmark the management of the farm, which is LPM, and the wealth of the farm, which is land building finance. If you're a new farmer, your LBF will be high. If you are an old farmer that's paid off all his land, your LBF will be low. Now, if we even it up by saying you're paying yourself land rent, then it becomes a little more manageable to benchmark. Now, at the very bottom, you're going to see what's circled is the total cost of production. So when we talk about break-even analysis, that is the numbers that we're looking at. So I know that for each of these crops, this is the total cost of production. When we talk about profitability ratios, this is where we get into some of those discussions around LPM, LBF, and you're going to see in this slide, it's a percentage. And what it is it's a percentage of gross revenue. The reason I don't do a per acre here, guys, is because if you're in a different geography, it makes it impossible to benchmark on a per acre basis. Do you grow pulse? Do you grow canola? Do you grow wheat, barley, oats? Different yields, different numbers, different geographies. So the reason we do it as a percentage of gross revenue, this makes it so that we can actually compare it across several different factors and different geographies, different provinces, different countries. And all this says is these are the marks, red, yellow, green, of where the average producer should be sitting to feel safe. Now, I'll be the first one to tell you a very significant section of our clientele sit in the yellow when it comes to LPM and LBF. That's what happens when it comes with expansion. If you've pushed the limits the last few years, you're probably going to be sitting somewhere in the yellow unless you've really done it with a very efficient manner. Now, when we jump into the return on investment, this is where it gets a little more interesting. When you look at return on investment, this is that same farm and it goes down further. So you see the cost of production, which I showed you before. Now, the next steps is we've now identified that based on those yields that our 10-year averages that we put in, we now know what our break-even yield is, our break-even price is, and we know where our returns hit. So if you were selling today, and I believe canola somewhere in the 13.5 range, I could tell you today that we'd be somewhere around a 15% return on this farm if we sold our canola today. 15% on a farm on average is a very good return. So all of a sudden, this tells your marketing agency or it tells you that we probably could sell a few bushels of grain and have a pretty good return. Now, if you look at wheat at 816, that's a different story. But again, going back to my discussion of my story before, is 816 attainable? And if not, what's the value that we are comfortable with? If 709 is our break even, can we get that? If not, what's the loss amount we might have to sell to because canola is already giving us a 15% return? This is the discussion purposes we have to have. The last discussion goes around opportunity cost. When we look at present value of sales, so this is a pretty good example. So on December 31st of 2025, if right now you were shooting for 1450 on your budget on canola, if you decided not to sell and hold that canola till March, now you have to get 1468. And this farm has an operating line, and I believe it's a 4.95% rate right now. If you hold till July, 1493. If you hold till next December, 1524. And I think this is the one that's probably not discussed enough, is what does it cost for us to lock the bins? I know guys that have held grain over multiple years, and I know they've had a return, but I know they also haven't calculated what the carry cost was or what the lost opportunity cost was. That's where these discussions start to come in. Okay, we are going to jump into the risk management side. And again, as I mentioned before, risk management is not just insurance. And I think that that's where the buzzword gets pulled across. When I talk about risk management, I talk about three really significant areas. The first one is risk transfer. And again, that's the insurance options, the short and long-term strategy, the government options. How are we going to set up essentially that side of our business to make sure that we don't go backwards? The second part is lean management. And the reason I call this a risk management technique is this is going through all of your variable and fixed expenditures and identifying areas where we can cut costs. And to be fair, going into 2026, this has probably been where the majority of our discussions with clients have been, is how do we minimize our exposure because we know multiple things that are coming. Right now, if you look at prices, they're not strong. Some areas of Western Canada still have not seen rain, so maybe we're looking at some drought areas. Or I'm talking to Manitoba today, maybe we're looking at some areas that are too wet. And then we go with that next step further and we say, from an expense standpoint and a lean management standpoint, how can we cut certain costs so that we do not have the amount of risk that we're holding? And I think part of the discussions that we're having right now is that not only are we looking at a downturn year, probably in terms of price, we're also looking at it because of the price drop in terms of insurance. There's not an insurance product outside of AgriStability that is not affected by a drop in price. So your crop insurance, even though it's a yield insurance, the price and the fixed price that goes with it is going to be lower this year. They take that price over the next few months here. Right now, the pricing is not as attractive as it was in prior years. So again, we know there's going to be less insurance. If you're looking at the private ones, same thing. They do a yield index. They look at next year's projected income. Well, next year's projected income is lower than it's probably been in the last 2 to 3 years. So insurance we know is going to drop. Agri-stability, because it's a reactive program, it's based on past historical, it's not going to drop as fast. But if we have multiple years of this, it will. So what do we do when we know the insurance is dropping and our gross revenue is dropping? We need to control our costs. And what comes in mind here is on the lean management side, it's a strategic reduction in variable and fixed expenditures to lower your cost of production to a manageable level. And when I say manageable, there's not much or not many farms that I can drop costs enough to essentially get them out of a loss scenario. It's really hard to manipulate costs in a 1 year period. But can I mitigate enough less risk that all of a sudden it's not as big of a hit to working capital, or it's not going to tie into cash as much, or it's not going to affect their debt service as much? Again, going back to the key performance indicators, every decision we make is based on those three ratios because those three ratios are how we run our business. So, on the lean management side, we'll get into some of those discussions. And then the last one is benchmarking. If I don't know how I compare to some of my competitors, it's really hard to say whether I'm a good farm or a bad farm. And I can look at profit numbers, I can look at that. It's not as concrete as what are other producers in my same risk area or same management area or same size doing that's working. And then at the same time, when I talk benchmarking, it's not just against other farms, it's against yourself. So in my own operation, what have my costs done over the last 5 years? What's my capital done? What's my debt per acre done? Am I creating a bigger risk area within my own operation, not even comparing to other farms? So it's the analysis of comparison across operations with different and or similar geographies, operations, and financial indicators. So when we talk about the risk management side to start, we're looking at treating and monitoring risk. So first thing you need to do is identify the risk. Then there's 4 areas where we talk about on risk management. There's avoid it, reduce it, transfer it or share it, and retain it. Avoid means it's a highly likely risk and it's very severe. That may be a change in operations, change in strategy, full diversification, something you're not knowledgeable at. These are all areas that would create a significant amount of risk. And the answer to that is don't own it, don't do it, don't say it, and don't expense it. Second one we have is reduce. And to be fair, that applies to all risks. You can reduce risk at any time. It doesn't just have to be during a downturn. A lot of times I have farms that during the good times is when you should be risk managing so that you can survive the downtimes. And that includes things such as SOPs, for example, having those processes on the farm. We talk safety a lot. Safety doesn't seem like a financial risk, but it is in terms of if you were to have that big catastrophic event on the farm, a death, a disability, a divorce, even. What actually happens to the farm and can we survive it? That's where the process side comes in. Then you have segregation, diversification. For example, I said diversification can be a big risk. It also can be a reduction of a risk, which means if all of a sudden land prices are too high for you to make money, what other business model can we go into that takes some of the pressure off the farm? Then we look at transfer share. That's the insurance side. That's the rent side. That's the agreement side. So when I talk about agreements, I'm talking about shareholder agreements and prenuptials and anything that comes with a safety net to transfer some of the risk away from the operation. And then the last one is retain. And when I say retain, that means the risks are not they're negligible, they're not severe, they're not likely. And a lot of this is essentially we absorb, we self-insured ourselves, or maybe we co-insure, which means we take high deductibles because it's just not significant enough that it's going to hurt us. Now, same farm, going back to that same scenario. And as you're going to see, what I've done with that farm is I've dropped the yield by 50% because I needed to know with the insurance they have in place, and this is a last year file, what happens if the yield drops 50%? And what you're going to see is the crop and private insurance based on the mix they had, this is what kicks in. And by kicking in, if you look at the bottom, the earnings loss from operations, the farm now ends up somewhere in that $560,000 of loss. Now the discussion turns to, is the farm strong enough on the balance sheet, the working capital, the debt service to sustain that loss and be okay? If it is, great. Our insurance kicked in at the right spot. It minimized our risk to an acceptable level. If all of a sudden that loss is going to be catastrophic to the farm, we need to start looking at other areas, which is either more insurance or you see the labor power machinery, the land building finance, those areas have to drop because as those areas come down in costs, it reduces our risk and reduces the loss. Now, when I talk about lean management, and this one I learned out of the TPAP program in the US, the most interesting thing they did is they had us pass around our booklets to each. So we had a table of 8. We had to write where we thought we could cut costs in areas on our farm. Then we'd pass it to one of the farms beside us, and they would write an area, and you'd so on around the table so that you had a whole bunch of areas that maybe you hadn't even thought of for your own operation that someone else had. So in this example, this is some of the high ranking areas that we find on a lot of farms. Repairs and maintenance. Maybe there's stuff that we don't need to fix right now. We were going to, but all of a sudden this isn't a good year. We're going to put it off. Supplies and small tools. Maybe we're going to buy new set of tools for the shop. This might not be the year. Labor efficiency. Maybe we're going to do a whole bunch of projects on the farm and maybe we're just not going to, and we're going to save some of the labor hours. Equipment efficiency. We're going to run our equipment for more acres, not buy that extra combine, not buy that extra drill, and we're just going to push the equipment. Travel entertainment. Maybe we're not taking the farm team out for a golf lesson this year, or maybe we're not going down south with the husband and wife. Ownership draws and salaries. Maybe that new boat is not coming. Debt structure and leverage model. Maybe we can restructure some of our debt to get our lower interest rate, to push out some of our payments, conserve some working capital. And the last one, fuel volumes and delivery methodology. A very large spot that nobody ever looks at is if you were to buy bulk fuel at certain times during the year, could you save enough to actually pay the cost of having a bigger tank? Or can you manipulate it like that? Can you treat it like your inputs and your sales and try to hit the lows? Now, once you've figured it out, one of the methods that we utilize a lot, so let's say we took supplies and small tools. They call it the scamper method, but it's essentially a listing of identification of how we could actually lean manage this. So just identifying the small supplies and small tools is an area we could reduce doesn't mean it's easy to all of a sudden reduce it. So this way, can you substitute it with something else? Can we find cheaper parts? Can you combine it with something else? Can we, maybe we have that part within our internal repairs and maintenance strategy already. Do we need to go buy it? Can you adapt? Can we use something else that's cheaper? Can we modify, magnify, minify, which essentially means, do we actually need it? Can we find other areas? Can we push this off? Put to another use. Can we use some of these small tools sitting around the farm for something else? Can we eliminate it? We just don't need it. Move on. Can we rearrange or reverse it? This is the different ways you can look at lean management. And this is just one of certain methods. If you go onto Google or go into the websites and ask AI, for example, how to lean manage internal repairs on a farm, you will get a whole slew of tools and ways to do it. Last one, benchmarking. So all I did was I pulled some of our Maverick Ag benchmarking for this one. And keep in mind, we work with a lot of very expansive clients. And what I mean by that is most of our guys come to us because they want to push, they want larger scale, they're trying to grow. And it doesn't matter what size they are. We've got lots of farms that are not significant, and we've got some farms that are 50,000 acres. It allows us to treat all the farms the same because the methodology is the same. It's just different capital, different financing, and different ways of going about it. So some of the coolest things we've seen is on average, our farms have expanded somewhere in that greater than 25% in acres over the last 5 years. So our guys are pushing the limits, and they're doing it, as you can see from some of our benchmarks, without putting the farm at additional risk. So with the increase of assets, which is about $9 million per operation, the equity has grown by 3.5. So they're still creating positive equity even through growth. The two areas to write down are probably that PP&E per acre is around $800 in 2024, and long-term debt per acre is around 1,000. Now, these are farms that are expanding. I would hope if you were to look at it, your numbers, if you haven't expanded lately, would be lower in both of these areas. But those are two benchmarks to keep an eye on your operation. Has that grown? Are you using your equipment less efficiently? And on the debt side, are you creating more risk? Second set, and I know these are small, but if you come back and look at the website, you should be able to see these a little closer. 30% growth in revenue per acre, around, so it's about additional margin of around 25% per operation. Now, over that same time, LPM has grown by 32% and LBF by 38%, which is significant. The fixed costs have grown. So when going to 2026, that's why lean management has become such a significant conversation, is that now we've had to pull back. The working capital increase, which is a very high positive, has gone up by about 35%, which means that these farms do have additional working capital in place to not only survive a downturn, but to be able to manage their decision making over this downturn. Lastly, debt service ratio did not fall below covenants over the last 5 years as an average across our firm. And that's something I'm most proud of is we've had a lot of ups and downs in the last few years, depending on drought areas, too wet areas, the commodity prices. We've been able to keep a consistent, not a highly variable net income. And then the last benchmarking, again, this one's more so you guys can come back to this slide and look at it later. It breaks down the production expenses, the labor, power, machinery, and the buildings and finance as a percentage of gross revenue per category. So this is the kind of detail that goes into a lot of our farms is not just on a total aggregate level, on a per line by line item of your income statement, how are you benchmarking across? Because if we find that your LPM's too high, that doesn't solve anything. It's where is it too high? How do we lower it? Which areas are concerned? That's what benchmarking, the power of it is. Now, to end this, guys, I just wanted to give one slide, and it's going to give a little more high theoretical. I've gone into a lot of detail during this, and I've rushed through some of it. But I want to go into what we call the blackjack card of farming. And what I mean by that is I don't have a crystal ball. I do not know where things are going in the next 12, 24, 10 years. But I do know these things. As of right now, the largest risk in agriculture, from what I feel, is access to capital. As I said before, weather, markets, policy, I think those are controllable through internal management. Access to capital is going to be difficult. As land continues to increase and as our debt service ratios continue to get tighter because of not only the cost of land, but the flattening of the down cycle, the prices, all that stuff, the ability to continue to grow is going to get harder for farms. Now, for those that don't want to grow, great. I am all for sitting there, creating a treasure chest, getting it ready for transition. There's nothing wrong with that, but access to capital will be an issue for a lot of farms. One anomaly year in agriculture will lead to 3 years of depressed profits due to a change in habits. The reason I say that is what we have found, and this is not only through psychological testing, but through a lot of other studies, is that one bad year is not just one bad year. So if you normally bought your inputs in the summer before and sold your grain in the summer after, and for 1 year it was better to buy your inputs in May, all of a sudden you're going to change your habit. Don't do it. One bad year should not change what you've created and the probabilities, because if you go back 30 years, the best time to buy your inputs is still the summer before the year. That's the type of habits that we need to make sure don't change just because of a down year. There's $100 per acre variance on gross revenue, the top 20% of operations. Agronomy, marketing, and procurement are keys to success. What I mean by that is we are really good at, as farmers, we're really good at talking yield. Coffee row, in the combine cab, look at the calibration monitors. We love yield. We need to start not only talking yield, but also talking marketing, margin, procurement. When did you buy your inputs? Those are the keys to success, is not just focusing on yield, but focusing on the entire operation from an income, margin, net earnings standpoint. Iron disease is a real addiction. Guys, labor power machinery has gone up exponentially over the last 10 years, and we like to blame machinery manufacturers and we like to blame the cost of labor. It's not just the cost and inflation. It's that as managers of operations, we've let it occur because we've got comfortable. And what I mean by that is, how many acres per combine are you doing today? How many did your dad do? And you can say, well, I need to get it off quicker. Okay, what does 2 grades on a wheat grade cost you per year? And what are you paying in amortization on an additional combine? Because the amortization on one combine worth $1 million is $150,000 a year. So unless that grade decline was worth that additional combine, those are the discussions we need to start having. So that ties into the next one. Expansion can solve problems even in today's environment if you know your machinery units. So if you're over machined and you know you could take on additional acres and still use the same machinery line you have, that expansion, even on high price land, most likely makes sense on $1 per acre. Now, on a debt leverage, we still have to run the debt serviceability and all that other stuff. But the majority of farms that count out buying land because of its value today haven't taken into account that averaging the cost of your machinery and your labor over more acres most likely will drop faster than your land building finance will increase, especially on farms that have a lot of owned land. And lastly, keep this one in mind. There's only 10% of farmers under the age of 40, guys. The real magic trick to me is how we have this transfer of wealth and knowledge over the next 8 years. And the reason I say 8 years is that if you look at the baby boomer generation, 2033 is the year that the baby boomer, the average age, crosses life expectancy built out by life insurance. And what I mean by that is we are going to see a lot of exits in the industry by 2033. And the majority of the industry is those exits. So 65% of farms are in that age range. Only 10% are under the age of 40. Going back to the access to capital discussion, this to me, if you want my opinion, this is the biggest risk in farming right now. It's not the price of land. It's not the tightening margins. It's not the cost of production. It's the fact that we have not moved succession or transition ability in 20, 30 years. All right, guys, I want to thank you for this, and I'll let Ashley take over right away. Just wanted to highlight, you can hit the Q code. It'll take you to our website if you want to have more discussions like the ones I just brought up. Also, if you're an FCC client, reach out to your rep, ask them about Advisory Plus. We are a collaborating firm with FCC, so you can actually have these discussions with us through some of the FCC subsidized programs. All right.
Awesome. Thank you so much, Evan, for such an informative presentation. We do have a few minutes for questions here. So if you have any questions, be sure to put them in the Q&A box at the bottom of the screen. If you don't see the Q&A box, there'll be 3 little dots that say more. Click there, and then you might see the Q&A box. So at the very outset of the presentation, you mentioned that one of the big challenges about talking finances with farms is that it's kind of an emotionally charged conversation. It's very emotionally charged to think about for a variety of reasons. So do you have any suggestions for folks onto either how to go beyond the emotion or how to navigate that emotion so you can still be effective in this conversation despite it. I don't know if it's too challenging and no one
No,
answer, but
no, I actually get asked this a lot, Ashley, to be open with you. And a lot of
yeah,
it revolves not just around finance, but around the succession transition. How do you start conversations in
yeah,
general on family
yeah,
farm dynamics?
yeah,
And the big one for me is, and this one might not be liked a lot, you need to rip the band-aid off. And the big one is if you're scared to do it alone, bring in your advisor group. So a lot of the farms that we work with, we have what we call AGMs, which if you want the big fancy corporate word, annual general meeting where all the shareholders and everybody comes in and they discuss the strategy, what happened on the farm last year, what's next year. The best way to have those uncomfortable conversations come out into the forefront is to have those meetings. So most of our farms bring their bankers in, you bring your accountants and your lawyers, any of your advisors that are part of your team, and you have the family members in the room and you have your employees that matter, your management, your leadership, and you sit down and you force everybody to work on the business rather than in it. As producers, we're so good at working in the business that we get so lost. We got to get this done. We got to get this done that we don't have those high level conversations, not only about finance, but about transition, succession. What's the next steps? What's the goals? I mean, how many on the line can tell me what their parents or their 10-year goals are? Those are discussions that aren't happening. And the only way to do it is to rip the band-aid off.
yeah. Thank you.
Yep.
Um, I already mentioned this, but there's a ton of information there.
I
So
know.
if which is excellent. That's what we asked you to do. Um, so with all of that information,
Yep.
what's the first thing that the folks on the line should be doing? If they're doing nothing else, what's the first thing they start with?
I think I said it once in the presentation is you need to have accrual financial statements. And the reason I give that one is because that's the easy button. Because honestly, from your standpoint, you don't have to do anything. That's your accountant's job. So for me, when we started the Farmer Coach program, the biggest aha moment for me was I had a table full of producers. They were all in that 30 to 40 range, and they all had taken over the operation. Dad had either slowed down or he's just an operator now, or maybe he even moved off the farm. And through conversation, I realized that this table, none of them had actually seen a financial statement. So they were a CEO running multi-million dollar businesses, dealing with a whole bunch of stuff that comes with that, the complexities. And they never actually sat down with an accountant and gone through a true accrual financial statement. Am I making money? What are those key performance indicators? All of that information. So I think that the easy button is just the start. And what I mean by that is start at the layman's terms. So start with the financial statements. Once you get a handle on that, then you move out. Then you look at the KPIs because your accountant's going to go through those with you, or at least they should. And if they're not, I would force them to. And if they won't, go to your banker. Your banker is running those numbers for you every year. When was the last time you asked your banker to sit down and explain them to you? Because that's their job. So I think it's that pushing outward. And once you get the accrual statements, then you go into the KPIs, then you get into some of the benchmarking. Like it's a bit of a snowball effect of without those accrual numbers, you can't continue. Once you get the accrual numbers, honestly, much like the presentation probably was, it'll become overwhelming because the stuff you can do with that just 10x compounds.
Yeah, awesome. Um, so question here, as a farm, do we just blindly trust the advice of our accountant or our advisors?
No,
Or how important is it that we actually understand all of this ourselves?
no. And I've been asked that one a lot too. So a lot of what we do internally is I don't have all the answers, guys. In fact, everything I talk today is just information we have. I was just providing info. We provide a lot of our producers with the Excels, the toolkits, the resources to do it themselves. And the reason I say that is for exactly like this question was. If all of a sudden you start relying on your advisors, no different than a marketing guy that says, you know what, we're waiting for $14 canola and it never hits. Well, then you're blaming him. I don't want that blame. So for me, having those discussions with our clients, I need them to understand exactly what the ratios mean. I need them to know the importance of it. That's why I come across quite passionately because for me, I don't want to be part of something where I'm the one making the decisions. I just give the opinion. So even within my role at Hebert Group, Christian essentially is my boss, He will give me a decision. I will run the numbers. I give him 3 or 4 different options. These are what the outcomes are. He needs to understand each of those outcomes and he needs to understand how they affect the business. He makes the final decision. That's no different than we treat in our consulting is I'm here to educate, provide you the information. You take the information and do with it as you want.
Yeah, so I come from the agronomy side. I say the exact same thing for agronomy. I will give you my opinion. I will give you some advice. I will give you some tools to make that decision, but I want you to understand the decision that you're making.
Well,
Don't just take my word for it.
and the interesting part, and part of the reason I got into numbers, guys, is that they don't lie. And what I
Yeah,
mean by that is from an emotional standpoint, from a qualitative standpoint, it's always, there's always question marks. From a number standpoint, oh no, you can give me your financials. I can give you the story of where your risks are and what probably needs to be done to fix. The numbers don't lie. The data doesn't lie. If I'm pulling it out of your equipment, if I'm pulling it from your accountants, I get the true story. How you want to represent it or discuss it is up to you, but the numbers don't lie.
right. Yeah. So we're coming up to 10 o'clock. Just to wrap up, looking ahead, um, it seems like you're looking at that lean management being the way to go for 2026. Is that what you would advise most farms start looking at for the coming year?
Yeah, I think that's where the discussions are going, to be fair.
Yeah.
And it's not that I'm a pessimist. Don't get me wrong. I still have the guys planning on having a strong year, but let's go into it with a plan and a strategy. And if we have to adjust from there, great. So when I say lean management, let's pull back some of those extraordinary costs that maybe we don't need to spend. Maybe fertilizer wise, let's fertilize just for the yields we're producing. But if all of a sudden we get a whole bunch of rain or the commodity markets run or something changes, we can pivot. And what I mean by pivot is all of a sudden now we're going to top dress or we're going to spend some money on fungicides or we're going to put additional into the crop. Or on the lean management side, maybe we're holding back on upgrading a piece of machinery that we really think needs done. Well, all of a sudden we see a crop, we see some prices, we rerun the numbers. Now you pivot. So it's more about having the plan and strategy based on lean management, based on being a pessimist but leaving an open pivot to optimism so that we can ride the wave. And what I mean by that is, I don't know what 2026 is going to bring. I would love to say it's going to get bullish in the summer and fertilizer going into May is going to come down and the equipment is going to get cheaper. Who knows? And for me to say that I know is total BS. So it's more or less, can we create a strategy and a plan that mid-year or going into when something changes in the geopolitical realm, can we pivot?
Yeah. So we hope for the best, but plan for the worst.
100%. Yeah.
Yeah. So that brings us up to 10 o'clock. So we're going to need to wrap up for today. Big thank you, Evan, for sharing all of this valuable
You
insights.
betcha.
Thank you to everyone else who joined us today for great questions. This is the first of our, or sorry, this is one of our 5-part series of our Roots Results webinar series. We hope that you'll join us for our next one on February 4th, looking at crop insurance, specifically the Crop Coverage Plus program. We also have a variety of other events coming up, so you can come check us out at Ag Days. For those interested in soil fertility and dialing in your soil fertility, we have a 2-day workshop coming up here in Carmen. Our Crop Connect conference is in Winnipeg in February. And then, of course, that's when we have our annual general meeting. So we invite all members to come to that on February 11th in Winnipeg. If you're interested in any of the events, please check out our website, mbcropalliance.ca. And with that, we hope that you all have a wonderful day. We look forward to seeing you at our next event.